Welcome to Breaking News to Trading Moves. We are looking at a specific update from the utility sector that tells us a lot about the actual mechanics of the U.S. power grid right now.
That's right. We're focusing on Exelon, that's ticker EXC, because they've just put out some new numbers regarding their financial outlook for 2026.
And it sounds a bit dry, a financial outlook for 2026.
It does, but this is actually a very practical signal.
It's not just about one utility company then.
No, not at all. This is a broader indicator for U.S. power demand. We are seeing exactly how data centers and AI are starting to influence the grid.
Not just in theory, but physically.
Physically and financially.
Right. So just to set the stage for everyone listening, we're going to look at what happened with Exelon specifically, why the market actually cares about a utility's forecast, and then we'll go through the winners and losers across the entire chain.
Yeah, from the people making the power to the ones using it. It's a pretty clear chain once you lay it out.
Okay, so let's start with that headline news. Exelon, ticker EXC, reported their quarterly numbers. They topped estimates.
Which is fine, but that's not the story.
Exactly. The part that got people's attention was the guidance for 2026. They're projecting a very strong outlook. So why are they so confident about a couple of years from now?
Well, when you peel back the layers, there are two main drivers here.
Okay.
One is higher electricity rates,
Yep.
which is just the basic math of how utilities make money.
Sure.
But the second factor is the real story. They're pointing directly to rising power demand tied to data centers and AI-driven load growth.
So this is that AI narrative we keep hearing about, but it's actually showing up on a boring utility balance sheet.
Exactly.
Yeah.
And you have to look at management's response to that demand. They aren't just sitting there.
What are they doing?
They highlighted a much larger multi-year investment plan. They're spending capital to support reliability and to physically build out the grid to handle that extra load.
Okay, but I want to pause on that for a second. Why does the broader market care so much? I mean, utilities update their plans all the time.
They do.
Why does this matter to someone who isn't just holding utility stocks?
It matters because it's concrete evidence. We hear all this talk about AI demand in the abstract. People talking about chips and software.
Right.
But here we see it physically manifesting in the economy as electricity load. It validates the idea that these data centers are not just PowerPoint presentations. They're real buildings requiring massive amounts of power.
And it also highlights the specific business model utilities use, which I think is worth explaining. It's kind of counterintuitive compared to other businesses.
It's very different. In most businesses, spending money is an expense you want to minimize.
Of course.
In the regulated utility world, spending money is how you grow. It's called rate basing.
Rate basing. Explain that.
So basically, a utility like Exelon operates as a monopoly in its area. In exchange, the government regulates how much profit they can make. The deal is, if they spend money on infrastructure like, say, new transmission lines or upgrading substations,
Yeah, and the regulators approve it.
and the regulators approve it, they are guaranteed a set return on that spending.
So if they spend $1 billion to upgrade the grid for AI, they get to earn a percentage of that $1 billion back as profit.
That's it, exactly. So when they announce a multi-year investment plan, what they're really saying is, we're going to increase our asset base, which means we're going to increase our earnings.
But there has to be a catch. You can't just spend infinite money.
The catch is the customer. Bigger capital expenditure, or capex, ultimately means higher monthly bills for households and businesses. That raises regulatory pressure. It raises affordability pressure.
So if bills get too high, regulators might just say no.
They might. And that dynamic, that balance between needing to build for AI and needing to keep the lights on affordably, is what determines who wins and who loses here.
Okay, that makes sense. It's a balancing act. Let's get into the specific winners and losers then. First up, the regulated utilities themselves.
The logic here is pretty straightforward now. You're looking for companies that have two things: data center load growth in their territory.
And the ability to expand their rate base to serve it. They need the demand and the permission to build.
Correct. If regulators approve the infrastructure spending, it lifts the rate base, which supports steadier earnings growth.
So the obvious first name here is the one we started with, Exelon, EXC.
Right. They're heavily regulated, but they're in key markets like Chicago and the Mid-Atlantic, where this data center demand is really showing up.
Next on the list is American Electric Power, or AEP.
AEP, they're a classic example of this thesis. They operate in the Midwest and parts of the South where there's a lot of industrial activity and, crucially, land for data centers.
So if they can get the transmission lines built.
They fit this growth model perfectly.
And the third one in this group is Duke Energy, ticker DUK.
Duke is massive. They operate in the Carolinas and Florida. These are areas seeing population growth, but also that industrial demand. The Carolinas in particular are becoming a hub for this tech infrastructure.
So same logic applies.
Same logic. Increased load requires increased infrastructure, which leads to earnings growth if they manage the regulatory side correctly.
Okay, so those are the operators. But they can't build this stuff with bare hands. That brings us to our next category, the grid build-out and electrification suppliers.
This is the picks and shovels trade, right?
Exactly.
If utilities like Exelon are going to execute these plans, they have to buy physical things. They're upgrading transmission, building new substations.
Which means higher orders for equipment and engineering services.
That's it.
So who are the beneficiaries there? First on the list is Eaton, ticker ETN.
Eaton is a powerhouse in electrical components. I mean, think about it. Every time you add power to the grid, you need switchgear, circuit breakers, power management systems.
The stuff that makes sure you don't fry the equipment.
Exactly. Eaton makes that gear. And it's not just for the utility. The data centers themselves need Eaton's equipment inside the building.
Next, we have Quanta Services, ticker PWR. Now, they're a bit different.
Yeah, Quanta is less about the box and more about the guys in the truck. They provide the specialized labor and engineering to actually build the transmission towers and string the lines.
And that kind of labor is a constraint, isn't it?
It's a massive constraint. You can't just hire anyone to work on high voltage lines. It's highly skilled. Quanta has that workforce, so if capex goes up, their backlog of work usually goes up with it.
And the third one in this supplier group is Hubbell, ticker HUBB.
Hubbell is a pure infrastructure play. They make the utility solutions, the connectors, the insulators, all the hardware that physically holds the grid together.
It's a volume play.
It is. If you're building more miles of line, you need more of Hubbell's parts. It's very correlated to that capex spend.
All right, let's move to the third category of winners. This brings us closer to the tech side, the data center infrastructure landlords.
The connection here is about capacity. If utilities successfully expand their interconnections, which is what Exelon is planning, it enables these landlords to keep leasing space.
Because you can't build a data center if you can't plug it in.
You can't. So grid expansion is inventory expansion for these landlords.
The big names here are the real estate investment trusts, or REITs. First is Equinix, ticker EQIX.
Equinix is arguably the most connected data center provider in the world. They focus heavily on interconnection, which is just connecting different networks together. They need reliable, massive amounts of power. If the grid is robust, Equinix can grow.
Then we have Digital Realty, ticker DLR.
Digital Realty is the other giant. They are huge in terms of square footage and total power capacity. They focus on the wholesale side, leasing huge halls to the big cloud providers. They are directly dependent on utilities delivering the megawatts they promised.
And lastly in this group, Vertiv, ticker VRT.
Vertiv is a bit of a hybrid. They aren't a landlord, but they provide the critical infrastructure inside the data center, specifically thermal management.
Keeping the servers cool.
Right. And as chips get hotter and power density goes up, you need better cooling. But again, their growth is tied to the physical expansion of these facilities. If the utility can't deliver the power, the data center doesn't get built, and Vertiv doesn't sell the cooling system.
All right, those are the winners. But markets are never that simple. Let's talk about the potential losers. The first group here might surprise people. Merchant power generators.
This is a really nuanced point. You might think power demand is up, so all power generators win. But that's not necessarily true.
Why not? Why would a power generator lose out when demand is high?
You have to distinguish between a regulated utility and a merchant generator. A merchant generator sells power into the competitive market. They make their money on the spread.
When prices spike.
Exactly. When demand is high and supply is tight, prices spike, and they make a fortune. They like volatility.
Yeah.
But look at what Exelon is doing. They're building regulated, stable assets. If regulators get worried about reliability, they might favor utility-owned buildouts or long-term contracts to keep prices stable.
I see. So if the regulator says, we're going to guarantee a steady flow of power by letting the utility build a giant plant, that kills the volatility.
It brings more supply online in a controlled way, and that could pressure the competitive market and reduce the upside for those merchant generators.
So who are the names to watch here?
The big independent power producers.
Okay.
So names like NRG Energy, ticker NRG.
Okay, NRG.
And then there's Vistra, ticker VST.
PST.
and Constellation Energy, ticker CEG. They're all a bit different, but they operate in that competitive space. If the market structure moves back toward a more regulated model, it introduces risk to their business.
That's a really important distinction. Okay, next group of losers is a bit more tangible for the broader economy. Energy-intensive manufacturers.
This is the cost side we touched on earlier. Someone has to pay for all this new grid infrastructure. If electricity prices rise, companies that use massive amounts of power as a raw material will feel it.
It's a direct hit to their margins.
Right, especially if they can't fully pass those costs on. They are price takers on energy.
So who are the heavy hitters here?
You have to look at metals. Alcoa, ticker AAA. Aluminum production is basically solidified electricity.
An incredible amount of power.
Yes. So if industrial rates go up, Alcoa's cost of goods sold goes up immediately.
Then there is Nucor, ticker NUE.
Nucor is the largest steel producer in the U.S. They use electric arc furnaces, which use electricity to melt scrap steel. It's cleaner, but it makes them very sensitive to electricity prices.
And Steel Dynamics, ticker STLD.
Same logic. These companies are very efficient, but rising input costs are a challenge they have to manage.
Now we have one final category. This is what we're calling conditional losers. And these are some of the same names we listed as winners.
That's right. It all depends on how the timeline plays out. We are talking about the data center REITs again.
So Digital Realty, DLR, and Equinix, EQIX. We said they were winners. Why would they be losers?
Because of the physical bottleneck.
Yeah.
Even with strong demand, what happens if there are delays in interconnections? What if the utility can't build the lines fast enough?
Or what if there's local pushback on affordability?
Exactly. The town says, no, we don't want a new substation.
So they might have customers lined up, but they can't deliver the space because the power simply isn't there.
And that slows new capacity deliveries and leasing timelines. You have capital tied up in a building that isn't generating revenue. So while the long-term trend might be positive, the near-term execution risk is very real.
It really highlights how physical this digital revolution actually is. We think of it as code, but it's really copper and steel.
That is the key takeaway. Exelon's outlook is a reminder that power is the bottleneck for AI. You could have the fastest chips in the world, but they're just paperweights without electricity.
So for those listening, what should they be watching to see which way this breaks?
You need to monitor rate cases. Look at the utility filings. Are regulators approving these price hikes? You should watch the grid capex numbers. Is the money actually being spent?
Yeah.
And look at the interconnection queues. That'll tell you if projects are moving forward or getting stuck.
And those metrics will determine which of these trades actually play out.
It leaves us with a final thought. We talk about the speed of AI adoption being about software innovation. But in reality, the regulatory and physical pace of the grid will determine the actual speed of AI adoption.
You can't compute what you can't power.
You can't.
A very grounded reality check. We will leave it there. Before we go, a mandatory disclaimer. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thanks for listening to Breaking News to Trading Moves. We will see you next time.